Man, they can't even see you. You can't even show yourself, man. Get it, I get it. Hey, welcome to the Closing Beat, everybody. Happy Monday. How you doing out there? You have a good week? Good weekend? Hope all is good. Welcome to our show, The Closing Beat. We are financial advisors here at Jazz Wealth and just like to go over the stock market on a daily basis for you to kind of keep you updated on how things go. We're not short-term traders here. We're long-term investors. But a lot of times the day-to-day can teach you what's happening under the surface. Where's that tide rolling? And so I really love to look at the markets as much as possible. I think we're like the only advisors that watch the market, right? And we don't just like disappear for months on end and stuff. But it's Monday. We're not going to pick on people today. I hope all of y'all are doing well. We're going to get this thing started here. Hope you enjoyed the music while you waited. I did. And the show starts now. Hey, let's talk about this. This is the unofficial end of the summer, right? I mean, as far as the stock market goes, this is what we consider. This week here is the unofficial end of summer, although it's not technically seasonally the end of summer. That's what you typically get from the stock market. Volume starts to pick up. September tends to be a more above average type month. And remember, actually, let's go over here. In our letter last week to clients, I always like to show this. So this is both in spreadsheet format and in graphical format there. What we're looking at is each month. This is the Dow, by the way. So for the last 100 years, what's the average performance for a month? The percentage of time that it is positive. And then we just have the last 50 years and last 20 years. So what you can see is that if we go through a really long bull market like we did over the last decade there, well, you can see the impact of that. What I want to point your attention to is September. It ranks as the worst month on average over the last 100 years. It ranks as the worst month on average over the last 50 years, and it ranks as the third worst month over the last 20 years. Yeah. It is not typically a month that's known for being positive. The average gain is actually a loss. And if you look down here, this is just the 100 years, 50 years, and 20 years plotted visually so you can see September, bit of a rough go there, and then we perk up hopefully into the end of the year. So historically, it is not known for being the most exciting month. And we're kind of already getting started on that, huh? The month of September is not even here, and we're already seeing quite a bit of weakness there. Rough go of it last Friday. We were not here for that, but and really last week as well, if I could say that there. We lost over 3% in one day on the S&P. I know a lot of you were looking for a pullback. We've now pulled back to the 50-day moving average. And what I'm going to do is I'll pull it up here on the chart so you can see. Where did we stop today? This is the S&P futures. Where did we stop? Right on the blue line. The blue line happens to be the 50-day moving average, which is a good measure of sort of midterm to short-term trend, right? So a pullback to a rising 50-period moving average is a good sign. It's not magic. It's not some secret thing. It's just things that people like to look at. The most popular moving average, in case you're curious, is actually the red line, the 200-day simple moving average. Every chart you see, I mean, even on TV, when they show a chart of a price of some stock, you'll see that moving average there. I always paint it red on my charts because I like to get it, have it get my attention. It is the granddaddy of all moving averages there. Looking through the markets, energy was the only sector that finished off the week higher last week. Everything else was weak, and that kind of goes back to what I was saying last week. If you're an ESG investor, I've been hearing a lot of complaining lately. We don't do that here. We've never been asked to do that, actually. But those of you that invest in environmentally and social governance stocks, based on their score or however you decide, it's a rough go this year so far. And that's because you've neglected energy. Normally, it's probably not a problem. But in a year where energy is the only sector positive on the year, basically, you got utilities in there too. But when you're neglecting that, all that push to the upside is just sucked right out of your portfolio. So you got to be a little patient there if you feel strongly about that sort of thing. But nonetheless, energy was the strongest last week there. Most sectors are still above their 50-day moving average, which is good. Still bullish in the short term, which you kind of think of it as like this is a bullish pullback, at least until proven otherwise, right? So it's not the most exciting looking pullback there. It's rather aggressive, but most sectors manage to stay above the 50-day, just like the stock market. The only ones that have not, communication services back below the 50-day. It has been one of the weaker areas this year, and I'm sure you could guess why. And healthcare has really taken a punch here lately. Those are the only two sectors below their 50-day. Second best performer last week, basic materials, and I'm going to say it held up a little bit better today. It doesn't show percentage-wise, but if you look through the basic materials stocks, some of the heavier weighted ones just pulled down the sector. It actually didn't hold up too bad. I'm not going to write that one off yet. You got consumer discretionary. I use the XLY. It's up here at the top if you want to see what ticker symbols we use. I tend to use all the same symbols because they're the most liquid ETFs. That way, if you ever wanted to trade it, you don't have to go looking around for an ETF. You just always have the ETF you want to use. If you were to say, oh, okay, I see healthcare. I see what it did. I want to, buy it, sell it, whatever you want to do. Well, then you just know real quickly which one you can go to there. Bigger pullback in consumer staples last week as well, but that remains above the 50-day moving average. So for the moment, you would say it's just a bullish pullback inside of a recent uptrend off of the, really the 52-week lows. Now, the S&P and the Dow today were the only indices to actually get positive for a second. So the S&P found its way up there, literally hit the prior close, went about a point higher, and it said, that's it, sold off right into the close. A good way to see that, if you want to use like the SPY or Vanguard's one, you can just go to a 5-minute chart. And you can kind of see the day's activity, if it would load there, go like this. Here is your rally to the prior close. This right there is the prior close. Perk up there almost about 1 point, and that was really it for the day. Right towards the end of the day, this right here is the actual close. Pressure all the way into the close. The same would be true for the Dow, like I mentioned a second ago. In the dark black area, that is your during market hours there. Same thing, sell off into a close after hitting a brief moment of being positive during the day. The NASDAQ did not do that. A lot of weakness there, and that's because of your bigger NASDAQ names, which also weighed a little bit on the S&P. So I'm talking about the likes of NVIDIA, which is incredibly weak here. Semiconductors, to continue there. AMD. You got Apple down just a little bit on the day. I didn't get a good look at that one today, down 0.8% or so. But the S&P was helped because what do you got? Alphabet. Now it's down. The Alphabet was down. I'm sorry. Amazon as well. So they all kind of went right along there. Yeah. So my data actually was a little bit off, it looks like. Nonetheless, you had the help from energy. Man, look at that thing. 1.5% on the day. If you look at the sectors today, once again, energy and utilities. That's it. Everything else was negative there. Every single thing was negative there. Now, if you're looking for some good news, let me show you what we got here. Friday, we had a loss of 3%. We said, all right, well, how many data points? How often does that happen where you lost 3% on a Friday? And we zoomed out a little bit to get really nasty days. A loss of 2%, 2.5% on any one particular day is a rough one, right? Doesn't happen that often. So what we have here is every single loss, looking back 50 years, and the day that they saw the loss of at least 2.5%. So I've got it here because Friday's the focus at the moment. On Friday, we lost over 3%. That'd be the 38th time in the last 50 years that we've had a one-day loss of at least 2.5% on Friday. The average return the week after, 2.22%. And we say the week after because Monday could have been a holiday, right? It's not always the case where Monday is open. So 38 times the week after, it's the best performing week when there's a loss on a particular day of 2.5%. That's the good news. It doesn't look like we were trying to do that yet. We had one brief little moment, like I said, right after lunchtime where it looked like we were going positive. But nonetheless, here's the stats, right? So I did put this in our letter this weekend for clients. If you had to pick a day where it's inevitable, you're going to have a 2.5% loss or more, you would pick Friday. Let it happen on a Friday there, right? Because the next week's performance tends to be great. In second place is when there's a 2.5% loss on a Thursday. That's happened 46 times. The biggest or the most occurrences of 2.5% losses or more happen on a Monday, 60 times. That's almost twice every other day. And the number of times in the last 50 years that any day has lost 2.5% or more is 216 times. That's an important number. Think about it. 50 years, 216 times. It's not quite, but that's almost like saying an entire year. Remember, the stock market isn't open 365 days. It's open like 252 days or something like that. 252, 251. So almost an entire year worth of days over the last 50 that you would have a loss of 2.5%. So is it rare? Yeah, it's rare. But is it not something that that doesn't happen? No. I mean, it happens not all the time, but 216 times, right? So it will happen again. You think about it, if you're young enough, over the next 50 years, you're likely to see another 200 days where you lose 2.5% or more. So was that good news? Yeah, I don't know. I don't know if that was good news for you. I hope so. Nonetheless, we'll go back to the markets here. Let's take a look at oil. That was your reason for energy being stronger today. Oil itself up 4% all in one day. Looks to be starting a new uptrend. You would argue that, or technical traders would argue, you have a recent low after a series of lower lows, right? So a downtrend is considered a series of lower lows. Low, low, low. See how it's making a lower low? Series of lower lows, and then a change in trend is considered a rally that attempts to put in a low, which then turns into a higher low. That is recognized by 2 or more days of a pullback that then get reversed. Now, some people say when you reverse the last day of the pullback, that is the change of trend. Other people say, no, that's too soon. When you trade above the prior pivot high, that is what's considered a change of trend. In either case, if all of that was gibberish to you, know that there are two types of technical traders that actually think the trend has changed in oil. I will leave my opinion out. You guys can decide what you think, but at least you know what people are looking at. Remember, if you're going to use technical analysis, you are less interested in what you believe and more interested in what the masses believe. If I just told you a minute ago, the 200-day moving average is the most important moving average of all of them because everybody looks at it. You want to know where that sucker's at. It may not stop at the 200-day. It may not pull back and hit it and then bounce perfectly, but you know that there are a ton of people looking at the same thing, making decisions at the same time. That is what technical analysis is. None of that other hocus pocus stuff. And I've fallen for the hocus pocus stuff, by the way. Everybody has to. Okay, one thing I want to point out. Remember when we talked about companies that have a large amount of their sales or revenue, depends on how you want to say it, here in the United States versus overseas. I actually shared this chart with you where I looked at every single sector. Remember this? Let's go like this. A bit better. There you go. So we looked at every sector and we said, well, what percentage of, for example, basic materials revenue comes from overseas versus domestically? That was 46%. And you work your way all the way down here to utilities, which makes perfect sense, right? Utilities generate and disperse their power and energy here in the U.S., we hope. So only 2% of their revenues come from overseas. Most of their revenues come from me and you paying our utility bills and all that great stuff. Real estate is also very similar. Obviously, you can think about like, the campus apartment company, I can't think of their name, where they buy apartment buildings around college campuses and they rent them out. They make their revenue from those kids. 6.5% of REITs actually generate their revenue overseas versus here in the States. You look all the way over here, you got materials, tech, healthcare, and consumer staples generating a large portion of their revenue from overseas. And we talked about this and I said, well, what does that matter, right? Who cares about that? Well, when interest rates rise, and I was talking about the dollar on that particular day, when the dollar rises, it's better for companies that actually get their revenues from the States here. Well, just wanted to follow up on that and see how did things go. I thought about it over the weekend. So, well, are those stocks performing better? And if so, would you not want to know about it? Here we go. So let's go down here. What we did is we took the top 1,000 stocks, because that's easy to divide into 10 groups. The One American Campus Communities. Thank you, MW. Yes, that one. So we said, okay, let's take these here and let's go back to last year and say, we want to know the average performance of a stock that gets very little of their revenue overseas all the way to a lot of their revenue overseas. So this is a lot. This is a little. In other words, this would be the most, and a lot of them are 100% revenues here domestically. This would be something like, 10% of their revenues are domestic, the rest are overseas. Well, look at what you see there. As the dollar gets stronger, rates go higher, and things get a little concerning out there. You have the stocks that generate more of their revenue here domestically performing way better on average than those that generate their revenue overseas. That's going to continue, right? You'll have your fits and starts with the dollar and everything, but that's going to continue. There's no reason for that to change. So if you're looking for stocks, so I think about stocks that generate their revenues here domestically. Trying to think of a name to give you. I'm not trying to say to buy it. I'm just trying to think of a name. Something will hit me. Generates revenues overseas here. Casey's. There you go. All right. Depending on where you live, you may know who these people are. I grew up around one. So Casey's General Store. It's like the gas station. There's a lot of them, right? They generate all of their revenues here in the U.S. Their stores are here in the U.S. You stop on the corner, you get your twin bings or whatever you get, and that's what you have. So look, it's performing better. That's just kind of off the top of my head there. Now, going over here, what would be something over here? Well, remember the previous chart I showed you, basic materials, right? So that's an easy one. We could just say Newmont, right? Newmont. And that has been weak. Yeah. So Newmont Mining, this would fall in that last category there. So they're struggling, not necessarily because of this. Gold has been weak as well, but that's one way to look at it. So I really wanted to do was try to follow up on something that we previously talked about and see, is that momentum moving forward or was that way off? I'd like to do more of that because it's fun to give you, seasonal stats and kind of how things perform and how, the market itself, but it's also fun to follow up with that, I think, as well. All right, stocks in the news. Let's get on over to it, huh? 3M is finishing their, actually, I think it's another week to go. I want to say it was September. 3M is separating out, they're spinning off their food production / safety business out there. You've already been alerted if you own the shares. You've seen the notes that have come in. I've got lots of questions on those. And September 1st, actually, that's the date, right? So this will be done September 1st. You're seeing the effects of that starting right now. Oh, sorry. T-Mobile. We talked about this one the other day. T-Mobile, Barron's. If you look at Barron's over the weekend, it's kind of a fun thing to look at. They do a lot of analysis over the weekend there. They said the company has a huge advantage over its peers in the 5G space. Whole thing about them, maybe something to look at if you're interested. But that's considered news. Tyson. China is not importing their meats from Tyson anymore. That did hurt the stock today. Not quite as much as you would have thought, but remember, percentage of sales domestically versus internationally. Now you can look that up and go, well, what percentage of their revenue comes from overseas? I did not do that, but you could do that. We've done that in the past. This NVIDIA was also in Barron's over the weekend. They were pretty bearish on this one. They were saying that this stock here will not recover as fast as the others anytime soon. You can already kind of see that. A lot of the semiconductors did participate in this most recent bounce in the market. NVIDIA did not. And so relative weakness, you would say there. And Bloomberg maybe broke the story on this, that they're, remember Netflix is starting an ad-supported business there, and Bloomberg said it's probably going to be $7, $8, or $9 a month based on their analysis there. Didn't happen to bother the stock at all today, and that's all good. The remaining earnings. We've got Best Buy, Big Lots, Chewy.com, PVH, your Ralph Lauren, and Hewlett-Packard will report earnings. Remember, it's basically the end of earnings season, so it is not really that big of a deal. Right, I'll take your questions if you happen to have any, and otherwise we will get going through the rest of this week here, huh? Big Jackson Hole speech last week. Did you see how pretty it was? Told you they would set up that camera and make it just like, oh my God, I got to go there. That's all I've been thinking about all weekend. Got to go there. Giovanni wants to, boy, you're active. You do a lot of work there. You'll start a new portfolio on Alphabet and Tesla and Amazon and Disney. Very tough time to say, I'm going to be Mr. Large Cap. a very tough time. I can't say that I would be setting out to do that right now in a meaningful way. You know, if you're saying like, I'm going to start this portfolio, I'm going to put like 5% in there and try to scale up. I don't know. I don't think there's any hurry still. You like Best Buy, do you? I mean, I used to go in there as a kid. I applied there to work when I was in high school. I applied to work there. I said, I want to install some car radios and stuff, and they never called me back. MW says, shorting seems like so much work. I don't want to zero out my exposure, so I have to sell things. What a headache. Okay. I have a hard time shorting myself, but I don't think it's that much more work. My eye doesn't gravitate towards it as much. Yep. Oh, Mr. Funny Doc there, coming in with the Jackson Hole joke. Well, I appreciate you using that emoji rather than another one you could have used. Yeah. If you're not buying in a bear market, you're doing something wrong. There's blood in the streets. Scale in. I think a lot of people, I did a class on this for clients, that a lot of people get wrapped up on a particular price. It's tough to do. Think about the fund managers out there that are putting $1 billion into a stock. They can't do it in one price. So they get that practice of their buy. This is their pullback. This is their bear market. This is their opportunity. And you got to think like that. Yeah. I would encourage it anyways, because otherwise it would drive you crazy. If you're shooting for a price and you got your limit order in there and inevitably it comes right down to it, but you don't seem to get filled and then it bounces away, it drives you nuts. You guys know what I'm talking about. Any thoughts on Lucid? Nope. I think it's a very, very tough stock to buy. You need news. That's a news-driven stock. There we go. You need news for this one. There is no good reason for this to have any meaningful move higher. It is quiet at the moment. How do you talk your brother off the GME hype train? Oh, man. You punch him. Oh, you can't solicit violence here. I'm sorry. Tap him on the shoulder and say, bud, we need to go talk to mom. Yeah. Yeah. Roku, what do we do? Well, that's the Roku up to. That needs news too. And it's not getting it either. That is horrible. And flat, I should say. So it's one thing to have a stock that's discounted and you think, oh, it's fine. Yeah, I'll take a shot. But when it's sideways like that and just kind of bleeding ever so slightly lower, that is very, very tough to suggest, yeah, buy more. Get excited about it for some reason. Nope. Let somebody else do it, watch it happen first, and then jump on the train after that. It's easier said than done, but there's no reason to be aggressive on that one. Financially free finally. I like that name there. That's a good one. You've been shopping for a basic material stock, I'm assuming, with a good dividend and good value. They always seem to be tough to read. They're not very exciting either. I'll give you that. Try to put together a list for you here. But yeah, they're not exciting to look at. I will give you that. I can't pull up a scan fast enough here. Albemarle sticks out as one. I was trying to find how to look for that. We'll just put it up here and see. Now, I'm not saying to buy it now, and I don't know about their dividend. Where's the button? There you go. So here's Albemarle, one of the stronger ones, if not the strongest one in the sector at the moment. And your dividend is 0.5%. So I'm gonna be very confident that there's something better for you there. But if you're looking, that's the kind of thing I'd be looking at. Stronger than the market, stronger than the sector. Oh, is it like skipping around and stuff? Yeah, I see that too. Yeah. There's something going on there. It'll catch up, but either way, we're done anyways. You know what I mean? It's just a little bit slow. This must be moody as well. All right, we'll be back tomorrow. We'll see what happens there. Not really a whole lot of news, economic events, nothing right there. So the market is in a good position to be jolted one way or the other by the littlest of things. So I will maintain my comments about being aggressive here, and we'll see you tomorrow. I appreciate you watching, and thanks for all that, subscribing, thumbs up, and all that good stuff. We'll see you later.